Hi, everybody. Welcome to another episode of the 7-Minute Takeover, where we chat all things acquisitions. We're your hosts. I'm Liz Prey.
I'm Eamon Gamble. Welcome back, everybody, to another episode of our Deal Decode, where we dive into some of the listings found on the Village Wellth marketplace. I'm here with Rob Irwin, and I'm Eamon Gamble. Let's get into it.
What are we looking at today, Eamon?
We are moving from the west side of the continent that we looked at on our last deal code to the east. We're moving to Atlantic Canada, where we're going to be looking at a heavy equipment distributor. This distributor, we're not sure exactly where in Atlantic Canada it is, but I think we've got enough information to do a bit of analysis.
Yeah, sounds like a business could really move some earth, or at least help others do it. Financials look really strong. 11 million in revenue, it's quite high. Million in EBITDA. It's probably a low margin business, but high volume. 4 times multiple is not so bad as an entry point. What kind of focus would someone be looking at in this space if they were to consider Eamon?
Yeah, we've looked at a few of these types of opportunities in the past. So like you mentioned, distribution businesses can be quite low margin, so you got to pay attention to some of those pros and cons before deciding if you want to move forward with this. And some of these pros and cons, you'll see that's a kind of a two-sided coin. So for each pro that I'll name, there's almost a corresponding con associated with it as well. So the first is that this type of business can be very highly correlated with economic activity. So when there is a lot of money going into building roads, or if the resource sectors such as forestry and mining that are common in Atlantic Canada are doing well, this type of business is going to be in high demand and going to be moving a lot of equipment. Conversely, they would struggle with a declining overall market if those industries are impacted, or if government spending on infrastructure or private spending on infrastructure falls. Secondly, the business itself, because it's so tied to economic activity, one of the pluses that I like about this business is that it does actually have that service component. That's going to give you a little bit more recurring revenue to smooth out some of the bumps associated with the economic fluctuations. Because it's a distributor, there's only so many brands in the heavy equipment business. So depending on your relationship with those brands, are you selling or distributing on behalf of multiple equipment brands? Are you tied to one? The pros there is that it actually can be a really effective moat against competition. A lot of these distributors have geographic exclusivity for some of these types of products. They may also receive training from these brands to give them a little bit of extra expertise and relevance in the local market. The downside is you're tied at the hip to the success and the market demand for those specific brands. So if you're out there marketing, John Deere, and John Deere's not doing so well in the market for whatever reason, they're just not building a good product anymore, you may struggle as a company because of that fact. And the last thing I'll mention is, because it's a distribution business, the value you're providing is that you're able to get that equipment to people that need it quickly. That might mean that you need to actually sit on the inventory yourself. So you're going to have equipment in the lot, and you're going to have that ready to go for your customers, which means huge working capital cycles, massive inventory levels that needs to be financed. And if any products stop moving, that can have a really big impact on your overall finances. So that's generally, I'd say, what I'd be thinking about first when evaluating a distributor.
Even with those hurdles, there's plenty to dig into here, specifically typically with equipment like that. There's favorable financing arrangements with the dealer on the property as well to help the dealer manage the cost of that. These guys have a decade of operations in a community that is traditionally very supportive of the institutions around it. So that's a great positive in terms of this particular operation. The service component helps diversify. I think that's a really big deal. It's, even if they aren't selling a lot of new equipment, there's high margin or much higher margin on the service delivery side. And that typically increases as these economic cycles change. People will increase the maintenance and repair. With EBITDA at 4 times EBITDA, at over $1 million, there's a fair bit of room for growth, organic growth, and essentially expanding territories if that's something you want to do. So you have the capital kind of push through. And another great piece of this is the owner is willing to stick around at least for a period of time, which is, post acquisition is a big risk, and having someone, a steady hand there at the helm to help you along in that transition, super helpful. So what would be some of the key questions to fire off to the broker to get more information on this?
Yeah, I was going to start with a different one this time, but let's say financials. Yeah, we want to know what that normalized EBITDA is composed of. Does it fluctuate dramatically year to year? Is there kind of a steady base of cash flow that you can rely on before thinking about that kind of more volatile new sales type product? I'd also really want to understand two things. One is, what equipment are they selling, so that I can go take a look at that manufacturer and just see what their overall sales trends look like. And I'd want to know who their customers are. We haven't talked about it yet, but the customers are going to be likely construction firms. They're going to be resource firms. Are these companies doing well? Is there customer concentration? Are you overly reliant on one or two customers that are driving some of your revenue? So I'd want to know the breakdown of both the suppliers and the customers, as those could pose risks. I'd want to know the agreements that they have with the dealers. So do they get financing from their vendors to help that working capital need? Are they extended generous terms? What is the order turnaround time? If they need a new excavator, can they get it on their lot within a reasonable amount of time? That's going to determine client satisfaction and really the value that you're providing, or conversely, how much inventory you're going to need to hold to mitigate that kind of risk. And then I would also just be interested in what that owner is going to be able to bring to the table during that transition time. What is the specialized knowledge that's needed? Can we tie that owner into the future success of the company so that we keep them focused on, say, cultivating new client relationships, maintaining vendor relationships? What is it that owner thinks would be the most impactful thing for them to be doing during that transition period?
Yeah, I think the perfect buyer here is someone who has an industrial interest in equipment, obviously, and is very community driven again in that region of the world. And also, if you're looking to lift your portfolio with a heavy hitter, this might just be the deal to excavate.
Thanks, Rob. We'll be back to you with another episode soon.
Thanks for tuning in. If you enjoyed the content, please be sure to subscribe, follow us on social media, and check out our website at villagewellth.com.
Amazing. Nailed it.